Let me ask you something before you scroll past this. How does the same asset crash 34% in a single session while quietly trading 40% higher somewhere else at the exact same moment? Because that's not a hypothetical. That just happened in silver. In one day, silver futures imploded. Gold erased nearly $1 trillion in value inside 24 hours. And yet physical silver overseas barely blinked. Two prices, one metal, same time. And here's why you should care right now. This wasn't panic, this wasn't fear, and it wasn't random. This was a mechanical failure inside the system. Stay with me, because once you see how this works, you'll start spotting these breaks before they hit the headlines. If you're holding silver right now, if you're watching precious metals, or if you just want to understand how modern markets can fracture in real time, what I'm about to show you changes how you read price action from here forward. Now, before I explain what actually caused this, let me slow this down and teach you something most people never really learn about financial markets. When you see a silver price on your screen, you're almost never seeing the price of silver. You're seeing the price of a contract tied to silver, a promise, a derivative. Think of it like selling parking passes for a garage that only has a few real spots. As long as most people don't show up at the same time, nobody notices a problem. But the moment too many people demand the real thing, the illusion cracks fast. That difference between paper claims and physical reality is the foundation of everything that just happened. So what does that tell us? It tells us that price discovery in precious metals isn't happening where you think it's happening. It's not happening at coin dealers. It's not happening in vaults. It's happening in futures pits, where leverage rules and physical delivery is the exception, not the norm. If this is making sense, drop a comment below and let me know where you're watching from, because this audience is global, and I want to know who's paying attention right now. Here's what you need to know. U.S. silver pricing is dominated by futures contracts traded on the COMEX. These contracts allow enormous exposure with relatively small amounts of capital. The estimated paper-to-physical ratio in silver is often cited around 350 to 1. That means for every ounce of silver that can actually be delivered, hundreds of ounces are being traded as promises. So price discovery isn't really about supply meeting demand, it's about positioning, leverage, and who's forced to act first. You're not watching a market that reflects scarcity. You're watching a market that reflects who's underwater on margin. Now here's what's actually happening, step by step. Silver ripped higher earlier this month, up more than 60% in January alone. That kind of move attracts momentum traders, algorithmic funds, and leveraged speculators. Futures markets get crowded very quickly. When that happens, you don't need bad news to trigger a collapse. All it takes is aggressive contract selling. Large players dump futures, prices drop, margin calls hit, forced liquidations kick in, and suddenly, selling feeds on itself. The market isn't asking whether silver should be lower, it's mechanically forcing positions to unwind. Here's the sequence. First, you get a price spike that pulls in leveraged longs. Second, those longs get extended, meaning they're betting big with borrowed money. Third, a catalyst hits. Maybe it's profit-taking. Maybe it's coordinated selling. Maybe it's just one big player deciding to exit. Doesn't really matter. What matters is that once the selling starts, the leverage amplifies it. Traders who bought at 130 with borrowed money suddenly see their positions underwater at 110. Their brokers issue margin calls. They have two choices: add more cash or close the position. Most don't have more cash sitting around, so they sell. And when they sell, the price drops more, which triggers more margin calls, which forces more selling. You see where this goes. But here's the part that should make you pay attention. While paper silver was crashing in the US, physical silver wasn't collapsing overseas. In Shanghai, real deliverable silver continued trading around 120 to 130 an ounce, roughly a 40% premium over US futures at the bottom of that crash. That tells you something critical. The crash didn't solve a supply problem. It didn't kill demand. It just flushed leverage out of the paper system. And that gap, that spread between what futures said silver was worth and what physical buyers were willing to pay, that's not noise. That gap is information. It's telling you that the paper market broke, but the physical market held firm. It's telling you that real buyers, the ones who actually want metal in hand, didn't panic. They kept bidding. They kept buying. And they kept the price supported in markets where you can't just trade promises. Now let me show you what very few people are talking about. This divergence between paper and physical isn't just interesting. It's dangerous. Because when futures prices collapse but physical premiums stay elevated, the market hasn't found balance. It's signaling stress. Stress between what exists on balance sheets and what exists in vaults. That gap isn't just a trading opportunity. That gap is a warning sign that the system connecting paper claims to physical reality is under pressure. And if that pressure builds, if more people start demanding delivery instead of rolling contracts, the next move won't be a margin call sell-off. It'll be a scramble for real metal. This isn't new. This is the exact same playbook we've seen before. In 2011, silver became a global momentum trade, surged aggressively to nearly $50 an ounce, then collapsed violently on paper. Physical demand didn't vanish. It just got buried under forced selling in the futures market. Dealers reported strong buying during the crash. Premiums held up. And within months, the narrative shifted from crash to shortage. In 2020, during the liquidity panic in March, silver futures dumped below $12, while coin dealers and refiners ran out of inventory. You couldn't buy physical silver at spot price. Premiums exploded. Wait times stretched to weeks. The futures market said silver was cheap. The physical market said there wasn't any. Same pattern. Every time these conditions show up, crowded longs, extreme leverage, and tight physical supply, the sequence is the same. Paper breaks first, physical lags. Then reality reasserts itself later. And in 2008, before the financial crisis really accelerated, precious metals saw similar whipsaws. Futures sold off hard on forced liquidation, while physical buyers stepped in aggressively at lower prices. The pattern repeats because the structure hasn't changed. Zoom out and the bigger picture becomes clearer. Silver isn't just a monetary hedge, it's an industrial metal. Solar panels, electronics, electrification, energy infrastructure, all of it consumes silver, and supply doesn't scale easily. You can't just turn on a new silver mine overnight. So when futures markets unwind leverage without expanding physical availability, you're not ending a cycle. You're compressing it. You're storing pressure, not releasing it. And that's what makes this moment different from just another correction. The fundamentals underneath didn't change in 24 hours. The supply-demand dynamics for physical silver didn't reverse. What changed was the positioning in the paper market. And positioning is temporary. Fundamentals are persistent. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Is this definitive proof of manipulation? Not necessarily. Could this just be normal market function during a momentum unwind? Yes. Could large players be using futures to hedge legitimate physical exposure? Absolutely. Could this be a conspiracy? Maybe. Here's the thing. It doesn't actually matter whether there's a villain in a back room pulling levers. The mechanics are what matter. Markets don't need villains to malfunction. Structure alone can do the damage. Futures markets are built for liquidity and hedging, not for perfectly reflecting physical scarcity at all times. So instead of arguing about intent, focus on mechanics. Focus on spreads. Focus on delivery data. Focus on what real buyers are willing to pay when screens say prices are collapsing. That's where actionable signals live. That's where you find clarity when the noise is deafening. There are probably 3 types of people watching this right now. If you're a short-term trader, this was a brutal reminder that crowded momentum trades unwind without mercy. You might have been long silver. You might have gotten stopped out. You might be wondering if you should re-enter. Here's my honest take. Risk management matters more than conviction. If you're trading with leverage, you have to respect the reality that paper markets can gap against you faster than you can react. This wasn't a thesis breaking. This was structure breaking. So if you're getting back in, do it with position sizes you can survive if it happens again. Use stops. Use options if you want leveraged exposure with defined risk. Don't fight the mechanics of the market just because you believe in the story. If you're a long-term silver investor, someone who's been stacking physical or holding miners, or just paying attention to precious metals as part of a broader strategy, this divergence should sharpen your attention, not shake your thesis. Physical premiums, inventories, and delivery stress matter more than daily price swings. If you believe in silver long-term because of monetary policy, because of industrial demand, because of supply constraints, none of that changed this week. What changed was the price of a contract, not the value of the metal. So if you're in this camp, your job is to watch whether physical markets stay tight, whether premiums stay elevated, whether delivery stress starts showing up in official data. If those things hold or worsen, then this crash was a gift. If they ease, then maybe the thesis needs updating. And if you're here to understand markets better, if you're just trying to learn how these systems work so you can make smarter decisions across all your investments, this is a real-time lesson in how leverage distorts price until it can't anymore. This applies to everything: crypto, stocks, commodities, real estate. Anywhere leverage concentrates, forced selling can overwhelm fundamentals in the short term. Your takeaway should be this: when two prices exist for the same asset at the same time, the gap is the message. The gap tells you where pressure is building, and pressure, once it builds enough, always finds release. So here's what I want you to answer in the comments. Are you watching silver right now? Are you holding physical? Are you trading futures or miners? Or are you just here trying to understand what's happening in markets that feel increasingly unstable? Let me know, because I want to understand who's in this community and what you're focused on. Here's where I stand. I'm not chasing this crash, and I'm not dismissing silver either. I'm watching three things closely. First, I'm watching whether physical premiums stay elevated or widen further. If Shanghai premiums stay above 20 or 30% while COMEX trades lower, that tells me the divergence isn't resolving, it's deepening. Second, I'm watching whether futures open interest continues collapsing. If open interest keeps falling, that means the leverage is being wrung out of the system. That's healthy long-term, even if it's painful short-term. Third, I'm monitoring whether delivery stress starts showing up in official data. If we start seeing drawdowns in registered COMEX inventory or delays in delivery, that's when the paper-physical disconnect becomes a real problem for the system. Based on my analysis, this move was mechanical, not emotional. It was structural, not fundamental. The fundamentals didn't disappear in a day. Industrial demand is still rising. Supply is still constrained. Central banks are still printing. Deficits are still growing. None of that changed. What changed was who was holding leveraged contracts and whether they could survive the margin calls. If history rhymes and silver consolidates after flushing out weak hands, the move that follows could be significant. I'm not making a price prediction. I'm making a pattern observation. This kind of stress doesn't end cycles. It reshapes them. It clears out the tourists and leaves the committed. And when the next leg starts, it usually starts fast because there's less overhead supply to work through. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Look at the spreads. Look at the delivery reports. Look at the premiums at your local dealer. Don't take my word for it. Take the market's word for it. If you made it this far, you're the kind of person who doesn't just react to headlines. You dig deeper. You ask better questions. That mentality will serve you well, no matter what happens next in silver or any other market. If this breakdown helped you see something you weren't seeing before, share it with someone who needs to understand what's really happening right now. Subscribe if you want more of this kind of analysis, and stay ahead of the noise, because that's where the edge is. Stay sharp out there.